Good morning. I'm Ruth Hackney. I'm the CEO here at RASCW. I'm really excited to welcome Mark Eppli. I think he kind of doesn't need an introduction, but we'll give him one anyways, at least a little one. He is the director of the James A. Grasskamp Center for Real Estate at UW, and he is an expert in all things economy and real estate. How's that for pressure? We are incredibly excited to have him here today. We were joking a little bit earlier, that every time we try to schedule him, something dramatic happens. So hopefully that won't be the case this time. All of our attendees are muted so that there won't be any feedback or any issues with the communication. So if you do have any questions for Mark, make sure to put that in the chat function. I will be keeping an eye on chat more than the Q&A. So chat is the best way if you want to have a conversation. And you can go ahead and set it to go to all panelists or all panelists and attendees if you want there to be a little bit more of a conversation or if you have a comment on something that Mark has said. So, and then some questions we may interrupt. So if Mark does say something and you wanted a little clarification on that, I'll be keeping an eye on chat and let Mark know. But if you just have a broader question, we may leave those till the end. And then we'll talk a little bit about the real estate market and what's happening there towards the end of the presentation. So huge thank you to Mark for being here today and for Rick for helping us get this all set up, and Janine, of course, Smith on our staff as well. So excited to have you here today, and without further ado, we'll let the main presentation start with Mark talking about the economy.
Well, good morning all, and thank you for the nice introduction, Ruth. I enjoy working with all the Wisconsin realtors and certainly those of South Central Wisconsin as well. And as Ruth noted, it's like, okay, whenever we try to schedule something with you, Eppli, it's either a snowstorm or a pandemic. I said we should stop doing this altogether. But anyway, I think a good number of you have seen me present before. And what I end up doing is I have a lot of slides in a short period of time. I will be going through that. I'll have about 35 minutes of slides, and then we'll have 10 minutes for questions. And as Ruth mentioned, if there's something specific on a slide that you think that you want to ask a question about, do chime in. So what I did is over the last couple of days put together a presentation, and actually this is all very fresh information because I really haven't done much in recent months. But Ruth, to her credit or fault, depending on how you look at it, she actually encouraged me to put more macro data in this. So if that gets long, I totally throw her under the bus on that. So with that said, we'll talk about the economy, GDP and employment. Those are the two big things, right? Then we'll start talking about geographic migration, housing supply and demand, and then the mortgage finance, kind of the credit box, okay? So let's go. Let's do this. Let's go into GDP right away, and let's take a look at this. So I'm going to move all of us out of my way so I can see you very well. Sorry about this for a second. But here we have GDP numbers. These are real GDP numbers. I include Wisconsin and Madison MSA. And I'll try to keep Wisconsin throughout these slides as red, go figure, right? And Madison is blue or purple. And what you'll see is since the Great Recession, we've generally done what the nation has done, which is pretty good because we have a slower growth economy overall, and we've done pretty well in Wisconsin and Madison. You'll start to see we might be tailing off a little bit in 2018 and 19, and that's real. And the real comes from a lack of folks to employ. We've actually have a shortage of employees relative to the country. With that said, there's two big components of GDP, and it's good to separate them and look at them and see how they might impact your business. So the biggest piece of GDP is consumption. It's consumers consuming it. It's $13 trillion. It's about 70%. However, business investment is only 18% of GDP or 3.4 trillion, but it's far more volatile. So you'll look at the axes I have here. It's actually changed in billions of dollars, not as a percent of the base. And when we start looking at this, the red line, which is private gross domestic investment, which is a smaller portion, is the volatile piece. So when it comes to the economy slowing or growing, I would look rather heavily at that. You'll see the real convulsion we had or disruption we had most recently with consumption spending going way down, but also coming back. So let's take a closer look at some of the confidence or lack thereof that businesses might have. So what I have here in front of you is data on CEOs. And if you're a CEO, think about how you're going to make decisions. And you're going to make decisions based on what you think is going to happen with the economy. And here's what they think. When you start looking at the US in particular, there's different shapes to the recovery. An L shape meaning it's gone down, but it's going to be very slow at coming back. U being slower, but coming back eventually. W, a second recession, and V, a good return quickly. You start to see the V is unlikely. So there's an expectation that this will be a slower recovery. Think of a Nike swoosh where we come down, we come back quickly, and then kind of tail off. It'll be hard to get some of those last jobs back onto the marketplace. As you have business leaders and CFOs and CEOs a little bit concerned about the economy, you can start to see the uncertainty index from a recent Economist article is pretty high. And when that gets high, they're less likely to invest. It's risky for them, right? And so they're starting to see less planning to invest in the coming a month. So it kind of goes to this slow and then not a snapback or a V type recovery. You know, that said, this is a lot of data here going way back in time. I don't know if I needed to do that, but it's helpful. You'll start to see 100 being the average of this index. You go above 100, you're kind of growing. You go below, you're shrinking. And you'll see most recently on the OECD survey that we have here, we're back above 100. And that's a big deal for Wisconsin. This is a manufacturing index, and we do more than average manufacturing here in the state. So that bodes well more narrowly for what we might have here. Let's go on. So I talked a little bit about the first piece, which is business spending. Let's look at consumption. And let's start by looking at personal income as well as savings. So let's start with personal income. That's the blue line. It's real, so it's inflation adjusted. And you look since 2015, that is some really solid growth. After inflation growing, 3 to 4% is really very good. And then you'll also note that the savings rate since the Great Recession, look at 2010 and to the right, you'll note that we're saving more. And that bodes well for the ability to make a down payment on a home. So those two I think are worth noting. But the other thing that's worth noting as far as the big disruptor is, generally speaking, when we step into a recession, incomes go down, right? People are employed, they don't make as much. Look what happened here. Incomes and savings rates went way up. So the government stimulus made a difference in consumers, and I think it allayed some of the fears of a wicked recession through that stimulus money. I like this one a whole lot. I think it's really informative to your business. And so let's start by looking at the two different lines. We have two different axes. Let's start with the blue line, and that's total credit to households. And that's going to be based on the left-hand axis. And you'll start to see that in 2008-9, that started peaking out. So this is total credit to, I'm losing track. Yeah, and you can start to see that peaked out in 2008-9, and this is based on the right axis. No wonder I'm thrown off. So it really shows you how much debt we have relative to GDP. And that's the real measure. It's like, how much are we growing? Are we growing faster than GDP? And when it comes to what we're really looking at as far as households in the United States, it's come way off the really high debt that we have. We certainly have growing student loan debt, some car debt, and a little bit of credit card debt, but mortgage debt actually has been very modest and barely above a Great Recession peak levels. The other piece, which is the red line, it goes to the household debt service payment as a percent of disposable income. So it goes, how stressed are our cash flows, so to speak? How much is going to making monthly payments? And you'll start to see we've got the lowest in the entire data series history. So that's why I kept it so long. So what we have actually is we have consumers that have lower debt rates as a percent of GDP, one, and fairly low debt service payments. So I think both those bode well for our industry, being the real estate industry, and being able to take out or take on new debt. Let's look at where consumer sentiment is. Consumer sentiment goes to what we might be thinking out into the future. Consumer sentiment is a little bit low now. It's the whole pandemic thing. We don't feel good about things. We can't go out to the places we like to go. We can't go to Badger football games, although they're going to go on, right? So this goes to what we feel, and if we're not feeling very good about the economy, we don't spend as much. That said, this number can be pretty volatile. So let's go on. Let's look at jobs as the second part of the macroeconomic background. So here again, I have Madison in blue, Wisconsin in red, and the United States in green. And what's being reported here are unemployment rates. It's pretty stunning. Since the Great Recession, Wisconsin and Madison in particular have had lower unemployment rates than the rest of the country. We've done really well at some level. One of the reasons why we've done very well is we haven't added quite as many workers to the workforce, which keeps our unemployment rate low. But this is very solid as far as a comeback for Wisconsin that might be better than the United States as a whole. This is kind of a messy slide in part because the 2020 data narrows it. But if we look at this, this is how many workers have, what's the new employment or employment growth. When we start looking at employment growth, overall, you'll start to see that since the Great Recession, that's the focus here, but it gives you a sense back in history as well, that the blue line, which is Madison, has outpaced the United States till about 2016, 17, and then it underperforms. One of the reasons for that, we don't have enough workers. We've run out of workers, and so you can't have employment growth if you don't have the workers. Same with the state of Wisconsin. Our unemployment rate was dipping to 3%. And below at times, limiting our ability to grow our workforce. So overall, what you're seeing here is we've had some pretty good workforce growth, but we actually ran out of workers. We need to figure out, we as a state and policy-wise, how to keep the best and the brightest here in the States and have less of a brain drain to other places. This is another slide. This is a slide you all should spend some time on as well. So what we have here is initial unemployment claims. So every week on Thursdays, the federal government comes out with their initial unemployment claims. And since the mid-March, we've had 61 million new initial unemployment claims. That's literally 38% of the workforce. So a big portion of the workforce was displaced and went on unemployment. Some are coming back somewhat quickly, which is really important. This gives you a sense of the number and the percent of those being unemployed. Here's why this is important to you. We'll talk about the credit box in a little bit, and the credit box is tightening. They're making it underwriting a little more difficult. And all of a sudden, when it comes to possibly getting a loan, how will the lenders, the banks, and the mortgage companies look at this unemployment and the riskiness of a loan to that individual? This could loom large for those where a family member has had to take unemployment for a period of time. So this is not a good news slide for real estate. So in summary, let's wrap this up. Let's talk about the employment and GDP. So first off, business investment will remain negative into 2020. Consumer spending usually follows business investment, so it'll be hard to get that back to 100%. It'll be a slow recovery. The challenge we have is there's been a fair number of those who've been laid off are temporary furloughs, but more and more of those are converting to more permanent. So it'll be harder to get some of those jobs back, even though unemployment rates have come way down. And we'll have somewhat slow growth in the coming years. So overall, if you want to think of the economy and summarize it in one statement, we're probably at a 95% economy. So we're going to come back, but it's going to be hard to get that last 5% back. It'll hard from economic growth as well as jobs. So it'll look a little bit like a Nike swoosh. We'll come down, but then we'll come back and then kind of tail off and have it really difficult to get those last jobs in economic growth back. So with that said, we probably need to take a momentary break here. And so one of the things I looked at, hopefully for fun, it's still a chart though, right? I'm an economist after all. I thought, okay, what could be fun and interesting to share with this group? And he says, and so I put this together. It says countries with the highest beer consumption per capita. So across over 200 countries in the world, we would rank at what, 6th or 7th after Ireland and Poland and Germany, Austria, Namibia, in the Czech Republic, as far as our beer consumption in gallons per capita. I don't know if that's a pride point or otherwise, but I thought it was a good little, how shall I say, a break between that and demographics. And when we talk about demographics, it's about migration, it's about supply and demand for housing. So that's what we're going to jump into now. When we start looking at demographics, these are terrible for your industry, but I think they're bottoming out. If people don't move, they don't need to buy a new house, you don't get to sell their homes. If you look at the top line, the green line, those are renter occupied. So on average, back in 1988, 35% of renter occupants moved. Today, it's 20%. More importantly, at the bottom, it's owner occupied. So back in 1988, and oh, by the way, if you go before 1988, I had all that data, but it was just adding noise to this. It was really at about 10 or 11%. About 10% of owner-occupied houses moved. They were mobile. You'll see since the Great Recession, it has hung out right at 5%. That is really limiting the number of new homes that are coming to the marketplace, and one of the core problems with getting new supply to the market. So with that said, this is a pretty important slide, but I believe this is bottoming out. We'll get to that, to the reasons for that as we go through the presentation. As we start to look at this, is who is not moving? And in this slide, let's focus on millennials. Let's look at the left-hand piece. You'll see that millennials that are 25 to 35 years old, in 2016, 20% moved. And then we do the same thing for the generations that came before. And all the generations when they were 25 to 35 years old moved at a much higher rates. That's not helping you. Additionally, what we have here is the young adult mobility rate on the right, which starts to reveal that we're at the lowest level as far as moving for this group around. So the millennials are really not migrating like they had in the past. They're not migrating, and they're also not owning a home. So if we start looking at 25 to 35-year-olds, only 22% own a home of the millennial group, but you can start to see around 30 to 35% owned homes in the previous generations. And in the converses, they're renting far more. That said, I think we're heading for something very positive. Millennials want to own homes. They want to have children. They want to get married, just like previous generations. Let's take a look at the impact of some of that in a few slides. This is a really messy slide, but one that I thought I would include because you might be able to use this data in your own work. I came across this for the first time in putting this slideshow together over the last couple of days. So what we have here, I'm going to start with the box, the inset box on the left. And the inset box on the left really looks at Dane County statistics. And it's for the 4 years, 2014 to 2018. You'll start to see that we've had move in and move outs from different states that are about equal. So people are not migrating to Dane County from other states. However, during that period, we have 3,000 more people move to Dane County than move out of Dane County at the during the same period. So what's really happening is other folks from the state are really coming into Dane County rather than from other places. Let's take a look at the messiness of this slide. Oh, let's go all the way to the right now and look at where they're coming from. You can start to see the biggest number moving into Dane County is coming from Waukesha County, Cook County, Hennepin County, and so forth. You can see the data. When you start looking at the data, you'll start to see that orange means there's a positive migration to Dane County. And you'll see that it goes right from Chicago and Cook County right up the coastline, not including Milwaukee, however, right up to the Fox River Valley. Those folks are moving to Madison. Interestingly, though, the adjacent counties to the left and to the right, or east and west of Dane County, actually have more people moving out of Dane County than in. So it's an interesting little slide. If you want, I would go to that webpage. You can look at the data is truly phenomenal when looking at that. So I spent far more time on that than I should have. So let's go on. We talked about migration a little bit. Let's now look at what's happening from the supply and demand perspective in real estate. What we're seeing over the last 5 years, is totally stagnant. Existing home sales right around 5.5 million. It really hasn't grown. We've got some volatility most recently, and you should have seen in yesterday's press release from NAR that they made it to 6 million home sales, a 10% increase year over year, which is pretty great, 10.4. Midwest was about 9.3%, which is good, which is solid. But this gives you a sense that we really haven't grown over the last several years. One of the reasons why we haven't grown is we don't have new product to put on the marketplace. We've talked about people aren't migrating. We also don't have new homes being constructed. This is data from Sam Cater, chief economist at Freddie. And one of the things he points out here is the low point in 82 and 90 really looks like the high point of where we are today as far as new home construction. And you go, that's underwhelming. We need more homes. With that said, that has contributed then to the month's supply of real estate. I should say contributed to the lack of supply. We're down to somewhere in the 3s. And you start looking at metropolitan areas in particular, we're probably down in the low 3s. I trust Ruth will cover some of that data for the south central Wisconsin. But this gives us a sense of the undersupply based on Freddie Mac estimates. And we're undersupplied by about 5 million homes. That's a problem. And that's a problem because it's also going to push appreciation rates up and maybe push people out of the market. It's great to have appreciation go up if you own a home, but if you don't, that's a problem. So let's take a look at that. This undersupply of real estate has had house appreciation rates at or above 5%, roughly speaking, since 2013. That's 2 to 4 times the inflation rate during that period. And so that's important because at one point, incomes need to keep track with appreciation rates to be able to afford the housing. And so it's great if you, like I say, if you own a home to have 4 and 5% appreciation rates, but if your income's only growing at 2 to 3%, that doesn't keep up. Went into the American Enterprise Institute, and what we see here from a realtor perspective, which might be interesting, foot traffic. And let's start with the top line, which is green. What is the foot traffic in for sale houses for rural? And there's a good portion of the marketplace we're looking at that is rural, and you'll find that foot traffic is back to almost 90% of what it was before the COVID recession and the COVID pandemic. You'll start to see that as you get to bigger and bigger metropolitan areas, you have a slower and slower recovery. So it looks a little bit more like an L shape, as you can see here. But I think that's kind of positive when we start looking at the surrounding areas around Madison. Another problem we have with supply goes to new buildable lots. So I've spent some time and wrote a little paper for the Realtors on this. If you look at the period, and this is buildable lots in Wisconsin, they have data from DOR on a month-to-month basis. What you're seeing here is that over, what is it, the 12, 13-year average from 1994 to 2006, we had about 15,000 new buildable lots. Since that time, we've had 3,500. Okay, it's hard to grow your single family housing stock if you don't have lots to build it on. Let's go to the next slide. And this gives you, it's the same data, by the way, but I put it in a slightly different context. Let's look at how Wisconsin has grown households on an annual basis. So for the 20-year period of 1990 to 2010, we've had about 21,000 new households each year in Wisconsin. And we had buildable lots of about 12,000, meaning we could put 57% of those into new houses. And that's about right. We have about a 65, 70% home ownership rate. 1990 to 2010 makes sense. 2010 to 2020, on the other hand, we have the same size growth in households, but we have very few new lots being built or being provided. And in the finished lots is really preventing the growth in single family ownership in the state. And it looks like 2020 to 2030 will have the same number of households growing. We don't know what the buildable lots are going to grow at. And that's a problem. Policy-wise, I ask you to get out and have your voice heard around some of this. I can talk at great length on this. It's probably a lending problem as much as anything. When we start looking at that, one of the reasons why the home ownership rate in the state of Wisconsin isn't growing is because we don't have lots for new houses to be built on. And it's a little bit disarming when you start looking back at 2004, the blue line is Wisconsin. I didn't make it red in this case, sorry, I got it backwards. Fell from over 70% to we're now approaching what national levels are as far as home ownership rates. And that's a problem. We got to figure out how to do this from a policy perspective. And I think the realtors, the WRA is really looking closely at some of this. But because as you can see here, we have a 6% drop in home ownership rates over a relatively short period of time, 12, 14 years. And here's what might help bring some of that back. This is unabated good news nationally. And for Wisconsin somewhat too, although we don't quite have as many millennials on a relative basis in Wisconsin as the rest of the country. So what's happened is from where we were about 20 years ago, the first time home buyer was in their late 20s, 20 years ago. Part of the reason for that is they married earlier and had children earlier. Both of those marriage and first time child have pushed out 4 and 5 years, which is pushing out the first time home buyer. So if the first time home buyer is 31 or 32, what we have is we have this push of the largest age cohorts for the millennials going right into that in the coming years. Now you want to keep track of the scale. So what we have here is it's going to be about, 500,000 more coming into that, but that could be enough to really push the demand for housing. I think this is a really positive number. And when we start looking at affordability, so once again I said, let's look at Wisconsin relative to the rest of the world. You can start to see that Wisconsin, as far as the, when we start looking at the price of the house to income, I'm sure you've all thought about that ratio. In Wisconsin, it's somewhere around 3.5. It is lower than over 100 other countries that maintain such data, and far lower than most. So one of the things we really do have is extraordinarily affordable housing in the United States, but then more narrowly in Wisconsin, which is kind of fun and worth noting. So let's wrap up the geography or geographic migration, housing supply, and housing demand. And what's our timing here as I look off to the side? How long have I gone? Whoops. So I'm about 26 minutes in. We'll go through the financial piece pretty quickly. So migration's at all-time lows. I think I'll pick up from that. Young adult migration is really much lower than other generations. I think that'll change too as we start to have marriage and build families a little bit later, but that's coming. There is a shortage of supply of existing homes and new homes, but I really think as well as buildable lots, especially in Wisconsin, but millennials will buy homes. I put that in all caps. I don't think that's an overstatement. So what I might expect, by the way, for housing demand is we're gonna see a spike, especially in the higher end homes, because people with money actually can buy a home right now. Those with less wealth will have difficulty. And we might grow from where we are at 5.5 to maybe 6 million, but step back to some of that a little bit in the future. So we'll do about where we were in the previous years, maybe a little better. Let's talk about the credit finance box. And let's do this in the next 10 minutes. I think we can do that and wrap things up pretty comfortably. So first off, let's look at household wealth. This is an interesting slide. So what we have with household wealth, and actually these numbers got updated in the last day or two as well. We have $119 trillion in household wealth in the United States. Stunning, great stuff. It's grown tremendously since the Great Recession. Here's the really big problem as it relates to many of us. Can you see the red line at the bottom of the graph? Yeah, it's somewhat hard to see. It almost looks like it's part of the formatting, right? Well, what we have is the bottom 50% of households in the United States in 1990 had 800 billion, and that only grew to 1.5 trillion in 2020. You can start to see the bottom half barely shows up. It's 1% of the wealth in the United States going to 50% of the people. If you spread that across the households, the approximately half of the 130 or so million households, a million households that are out there. That gets us to what, about the 65, 70 million households in that bottom 50% piece. If you divide that 1.5 trillion into that number, you get about $23,000 per household. So that's on average. That's for the young households and the old households. A large portion of our households don't have the money for a down payment. It's the same group that's likely displaced by some of the unemployment that we're seeing in first initial unemployment claims that I talked about earlier. Let's look at where that equity sits in housing more narrowly. And you'll start to see that I'm looking mainly at the yellow line, household equity. You see it dropped from about 15 trillion to about 10 trillion, now it's up to around 20 trillion. Nice rebuilding of household equity in the United States. And then you can start to see as well, there's about 11 trillion of debt against that house. So when we start looking at the 11 trillion of debt, how is that allocated? You'll see 7 trillion of that comes from the agencies. That's Ginnie and Freddie and Fannie. And the next piece would be banks holding on to some of these loans. So let's look at narrowly the Ginnie, Freddie, Fannie piece, because they provide 70% of the market. That's the 30-year conforming loan, right? So when we start looking at that, first off, rates are low. They're 2.87% low. That's just crazy. We've not seen such a low rate in the history of tracking this data, period. It's pretty great. Not only are they low, based on everything the Fed has said, they'll remain low for at least 2, probably at least 3 years going into the future. That will create a really nice demand for housing as rates stay low. But here's the challenge, and the challenge comes with the credit box. When we start looking at the credit box, we start with FICO scores, right? Fair Isaacson Company scores, those are your credit scores. When you start looking at this, I've got some data on GSE, that's Freddie and Fannie, and then Ginnie is separate on the right-hand side. You'll start to see in both graphics, the credit scores have stepped up. Again, a tightening of the credit box. You'll start to see that Ginnie has a lower average, but still that is stepping up, making it more difficult for people on the fringes to own a home. As a matter of reference, the average credit score in the United States, last I looked, and that might be about year-old data, is a 699. So you can start to see that the average person will no longer qualify, or just barely qualifies, for a Ginnie Mae loan, and certainly not for a conforming loan. From there, we go from credit scores to loan to value. And when you look at the left-hand side of this slide, the average loan to value, or median, I should say, has really fallen from 80% to about 72%. That's a pretty big drop. So again, it shows some of the tightening of the credit box. On the Ginnie Mae side, they really sit right at the maximum loan to value for a FHA type loan. Next tightening of the credit box goes to debt to income. So what is your debt service payments to income? And you'll start seeing both these, they've dropped off, and dropped off fairly dramatically for the GSE, Ginnie, and Freddie and Fannie loans. They've gone from about 36% now to about 33 or 32% in most recent data. Additionally, we've seen a tightening as well from Ginnie. So from credit scores to loan to value to debt to income, all of them have tightened. And in the underwriting has tightened as well. It's harder to measure that. When we start looking at this, additional tightening comes in the form of fees that are charged. So not only is it tightening, but they've raised the fees. It doesn't look like, and they really haven't raised the guarantee fee, which is the left-hand side of this, which is about 60 basis points, a little bit under. But the break-even guarantee fee for these folks should be about 26 to 30 basis points. They're really starting to recapitalize Freddie and Fannie through excess fees being charged, both on the left-hand side with the ongoing, but also on the right-hand side with loan level price adjustment. So it's that upfront additional percent, which again makes it harder for folks to get into a home. That said, the share of first-time home buyers as a part of the mortgage market is growing a little bit, which is a good thing. The share of first-time home buyers is staying right about 33 to 34% of all buyers, a number that might be interesting and important to you. So let's wrap up mortgage finance, and I'm right at 33 minutes, so I've got to do this in a minute and a half to stay within my 35. So it's a mixed bag. Net worth is growing, but it's not growing for everybody. The 30-year interest rates are crazy low and will stay that way. Freddie and Fannie, their regulators pushing them hard to be more conservative. So they're going to continue to do that, given the views of Mark Calabria and FIFA, Federal Housing Finance. That will continue to be a concern, which is pushing the credit box tighter. And the challenge here, which is difficult to kind of tease out of some of the data, but wealth and income inequalities really could limit some of those under $300,000 or even under $250,000 priced homes. So in short, Freddie and Fannie is focusing heavily on safety and soundness at the requirement of their lender. And before I go into the very final slide, I think it's also interesting, and I kind of doubled up on this, to look at the ratio. What's a second? Oh, anyway, we won't have a summary. We'll go right to the ratio of bars to grocery stores in the United States. So this was some research that was done that I couldn't help but include as a kind of a fun way to end. But I'm sure you cannot figure out the outline of the state of Wisconsin, where we have far more bars than the rest of the country relative to grocery stores. So with that said, I will hand it back to Ruth, and I'll take us out of this sharing of the screen. So that's all I have.
I found that last slide pretty interesting, Mark. I'm from Montana originally, and I feel like there was one other location where that trend occurred, and it was Montana. So apparently I have a trend as well. Bars over grocery stores. We do have one question already. Just remember that if you do have a question for Mark, you can go ahead and enter it in chat. I don't see anything in the Q&A. So the one question we have is from Matt, sorry. He asks if the moving out of Dane County to adjacent counties is because of affordability or perceived affordability in those counties as compared to Dane County.
Don't have specific information on this, as I'm very data driven, as you can tell. That said, that certainly seems to be the case. Dane County, certainly Madison, is gotten really quite expensive for a lot of households. And it's actually relatively easy to commute here. Some might disagree with that comment, but having lived in Washington, D.C. and in Milwaukee, this commute is really pretty easy. And the cost of commuting that distance is isn't that great. And I think we'll start to see that, Matt, as well as some folks, the COVID thing and interacting with others, that will have lingering effects for some people's anxiety levels, but also those that have, and that's a real thing, that's a real perception, but also for those with compromised immune systems will probably want to be a little bit further out. So I think that will continue into the future. But yes, affordability is a big piece of that, would be my expectation. Great question.
Yep. So Lori does have a question. She says if the Senate and White House flip and there's a change in energy policy, do you think that there'll be a possible effect for a rise in energy prices and other products?
As far as energy policy, I've actually followed that somewhat closely. It could slip some, but what we're starting to see here, folks, is we're right at about $40 a barrel oil. And when you start looking at the break-even cost of that oil, and for them to extract it, especially fracking in the United States, it's right about $40. We drop below 40, they stop producing. So the policy, and I understand some of the carbon pricing, among other things, which might be embedded in your question, could push on that. But that said, future expectations about growth in the use of and petro-related products is expected to be stagnant, with a lot of oil that can be somewhat easily extracted if you frack. So no, I don't worry about oil prices going much differently from where they are right now. Good question, because that can affect how far people are willing to to drive, and ultimately where they select to own a home.
We still have the ability to ask questions if anybody's interested. I think a question I have, and you hit on it a tiny bit as you were answering the first question we did after your presentation. We do hear, because of the acceptance of virtual working now, that there'll be a lot more demand on communities like Madison that are a little bit smaller and have more opportunity for kind of rural life combined with high services. What's your thought on that, and how does that compare with the trends that we've seen in the last 30, 50 years to move towards more urban areas?
Yeah, a great question. So there's two sides to that, and there's probably a kind of a bipolar response, so to speak, or a bifurcated response, I should say. So first off, I really do look, I'm going to go for the case for big cities. When you start looking at graduates at the University of Wisconsin or any of the Big Ten schools, where do they want to go? They want to go to Chicago. They want to go to the big city, have that experience. Now, they may not want to stay there. So to the extent cities, in cities including the size of Madison and Milwaukee, are able to attract the best and the brightest within certain clusters, and we certainly have clusters around education and government and healthcare here in Madison, especially with Eppli, as far as in exact sciences, healthcare and health sciences. The best and the brightest will want to continue to work with the best and the brightest. I think the clustering will continue. Cities will be sustained in the long term. That said, right now we're at a period where some are pushing out. And it only takes a couple of percent leaving some of the big cities, such as Chicago, and moving up to places such as Madison, to really change our marketplace. And those dynamics, I think, will happen as well. So I'm really going with both ends of this. I believe cities will survive. People won't be so concerned about this. And let me use a quick analogy on cities surviving before I go into rural. Let's go to 9/11. And when you start looking at after 9/11, what happened was a terrible terrorist attack. But for the next year, maybe 18 months, people didn't want to be in elevator-served buildings, especially the tall buildings in Chicago and elsewhere. Once we created we locked up we have a solid lock and door in the cockpits, and we have some degree of what do you call it? That you have to go through metal detectors. That issue went away. We covered it in two ways. I'm guessing the same thing will happen with COVID. One, we'll figure out social distancing a little better, one, and two, we'll come up with a vaccine that will take care of this issue. Could another COVID come along? Sure. But that said, we will have taken care of that. I think we'll look back on this and saying it was a blip in time, but it will scare some people away. And those some people could create enough of a demand for places like Madison, and even people wanting to be a little bit further away from Madison, in that they can remotely log in. That said, I believe innovation does not happen nearly as well online as it does in person. I think in-person meetings will continue to be required, and people will have the fear of missing out. And I think that'll be big, and I think that's important. So I'm answering that both ways. Sorry, long answer.
I've actually heard both answers as well. So it sounds like that's kind of the trend. Related to the rural side of that, we do have a question about high-speed internet access, and that business growth in areas where it is not available is quite lagging. Do you see that there'll be any sort of push towards getting high speed in more rural areas?
Well, who asked that?
That was Sona.
Sona, well,
Sana.
I had included in this presentation some work by Dale Knapp from Forward Analytics. Do look to his work. It's Dale, K-N-A-P-P, and it shows that people want to be in or near metropolitan or micropolitan area, micropolitan being between 20,000 and 50,000, metropolitan being over 50,000. But from there they go on to say high-speed internet has really been a problem as far as growth. That said, that's all going to change. And that's an overstatement in all likelihood, but I don't think so. Elon Musk is really working on that and sending out in different rocket launches anywhere from 30 to 50 satellites, and is creating a satellite network. And I know it's being tested right now, such that it's actually operable to provide high-speed internet across the entire country. So I believe that when that technology kicks off in the coming period, I can't tell you what that would be, but it probably within the next year, I think high-speed internet will be more ubiquitous than it has been in the past, and it will not be the impediment. It is definitely an impediment today. Go to Dale Knapp's research. It's good stuff.
Okay, awesome, thank you. Brian is asking, where does Wisconsin and specifically Dane County rank in terms of developer incentives to create more of the buildable lots?
Oh, I can't answer that,
Okay.
but let me give you a quick sense. So first off, it's a little bit around incentives. That's one of the problems. The bigger problem is providing capital to develop those lots. So what happened after 2000, after the Great Recession, one of the biggest losses that happened with banks were land loans, because land loans went from $1 to 30 and 40 and 20 cents on the dollar as far as what they recovered. Most commercial properties, the recovery was far higher. So the losses were biggest. They then put forth regulation. They put forth the regulation and additional reserve requirements that are higher for land loans, making it far more difficult and costly to get land loans. Additionally, bankers don't like being audited by the FDIC and others. And one of the things that when the regulators come in and look at their files, oh, that's an apartment loan, that's fine, that's fine, that's fine. They hit a land loan, they open that file up almost every time. The challenge there is the bankers don't want to lend on land because A, it's a red flag for the regulators when they come in. B, there was heavy losses in that area, so that was real. And so what's happening is we're not having adequate capital flow into that. The way that could happen is maybe some of that capital, seed capital, is provided by the municipalities to start that. I don't think municipalities should be land developers, by the way. I think that's probably a bad call in the long run. In the short run, it could take care of problems. But I think your question is a really good one. I would push hard on municipalities to look at resources, including the Board of Commissioners for Public Lands, for loans to the municipality, that fund then being used to support economic development in the form of land loans or support for land developers. As far as how we rank, by the way, we're okay. We're not great. We're not bad. Wisconsin's actually pretty good relative to the rest of the country as I know it. Madison has its own set of NIMBYism challenges that you're all familiar with, probably make them among the worst in the state and more similar to what you would see nationwide. Not worse than nationwide by much of a margin though.
Okay. We'll do one more question here and then I'll do a little presentation on the housing stats. This one's from Lori. She has a question about those remaining 5% of jobs that you think will take a long time to recover. She's actually asking if you think that businesses might turn towards automation instead of rehiring those positions.
Yeah, great question. Technology is always on the horizon. You go to McDonald's and you order from an iPad now, getting rid of someone in the middle. And I don't have to touch a person, so to speak, or take delivery in that way. In so many ways. We can see that from grocery stores and so forth. So yeah, I think one of the things is we're gonna innovate around this as we want to interact less with others. So not only is it something from a financial perspective, but I think some people have gotten far more comfortable staying away and not interacting with other humans when they do their daily tasks. And so to your point about that last 5%, I think some of that's going to be come back. It's going to be hard for it to come back, as well as some folks won't be comfortable spending money as they had in the past. I don't know how long it might take for some people to get comfortable going to a sports game or to a concert or to a busy a bar or restaurant. And that will limit economic growth at some level. So your question's a good one. Yes, I think automation will likely push some of those lower end jobs out of the marketplace, making it more difficult for the recovery to occur. Well, by the way, thanks for monitoring these questions. I think you did a great job, Ruth, and I look forward to what you have to present.
Thanks. All right, we do have one other question, but we'll maybe handle that after if we have a little bit of time. But I'm going to go ahead and talk about the market stats. And okay, can we see those? Oops.
Yes.
All right. Let me. All right, so here we go. All right, so we're going to just talk a little bit. I did kind of keep this high level because we do release a monthly market report every single month, as well as the Wisconsin Realtors Association. So a lot of deeper dive is available, but I did want to look at some kind of general stuff in terms of how this market has compared to past years and specifically last year, because there are a lot of similarities. And personally, what I found quite interesting is that we're not actually seeing a huge difference in the number of sales despite the pandemic and despite what is going on. Here we've got it broken out into 3 sections. We do have Wirex, which is most of Wisconsin. And you can see that the difference between the total number of sales, and this is for single family housing, but it's a good place to start in terms of telling what's happening in the marketplace. You're seeing just a difference of about a couple hundred listings statewide between the number of sales through August this year as compared with the previous year. And that trend continues in the region. We're actually seeing just a little tiny bit of an increase between the number of sales last year and what's happening this year. And then in Dane County, back to a decrease, which isn't a surprise. We're an urban area. We do have a little bit more limited stock, but I think that's quite telling in terms of what the demand is doing, that even despite a pandemic, the market is still incredibly strong. Also, so that ran those same numbers for this total sales volume for the same time period. And I think probably not surprising to anyone is that the sales volume, although the numbers are pretty similar or even a little bit lower, the sales volume has actually increased just because the demand has caused multiple offer situations and a pretty significant increase in that demand, which relates to a housing price increase. So throughout the state, we're looking at just under $12 billion in sales for single family housing, which is definitely a huge part of the economy. And then in Dane County, again, we balance out a little bit more in Dane County, again, just because I think that there is the urban area and the limited stock has kind of created a lesser number of sales, which, although they're greater, does somewhat limit what that price or that total sales volume ends up being. So this is kind of drilling down to the full region in our our multiple listing service, and we're talking 2018 or 2019 to 2020 comparison for number of sales. And this is more than just single family housing. This includes condos and townhouses as well. So you can definitely see that in the full region, we are seeing we did see quite a dip, coming in February, March. April, specifically May, probably saw the greatest dip on both the full region and the Dane County side, but actually quite a quick recovery in terms of the number of sales. And in August, at least in Dane County, Dane County and full region, we actually did see a slight increase from last year, which anticipates some of that recovery. Sales price is probably the biggest story here. You can see that Dane County continues to have the highest median sales price in our region. The region is about $250, but Dane County's current sales price, and this is based on year-to-date data, is $312,000. Some counties obviously are quite a bit lower just because of their rural nature. So that question earlier about perceived cost savings, I think it's not necessary, or perceived affordability. If you don't take any commute costs and gas into account, I think the numbers are pretty clear that there is not a perceived affordability difference. It is actually there. Dane County versus, like, say, Columbia, Dodge, or Sauk counties. Pretty significant change between those two. Dane County is another area, again, I just wanted to explore. This, I think that this, what's interesting to on this chart is it goes back to 2011, and it's looking at the kind of the highs and lows of the median sales price by month. So we're all really used to that cyclical up and down, you know, with the seasons and everything. But I think what's interesting about this chart is that we're not seeing a huge change in that cycle, despite the fact that there is a pandemic. So we are still seeing a pretty significant increase, and in those housing prices, again, most likely caused by the lack of supply and increased demand. So I am going to go into, as Mark mentioned earlier, the supply in a little bit more detail. So this is our region again, and you can see the counties that are included along the bottom. So according to the National Association of Realtors, 6 months of supply in a housing is considered balanced. And so you go a little bit on either side. And you can definitely see that across all of the regions that we are dealing with, there is definitely a either balanced or below balanced market in terms of supply. We're definitely seeing, you can see that in the blue, that is Dane County, and we are, yes, as he was saying, I think just below a 3-month inventory, so which is incredibly short in terms of supply. I think what's interesting and quite surprising, actually, probably just caused by the rural nature, is that Greene and Rock County actually have less supply than that, and they've been maintaining that. So it's not just a blip 1 month, maybe they had an increase of sales, but they've been maintaining a lower supply than even Dane County. And then the same, of course, with Columbia, Dodge, and Sauk counties. A lot more demand potentially in that area as people are trying to find opportunities for housing, and not seeing that in Dane County. So it is a tight market across the board. This mimics what is happening across the nation. As the National Association of Realtors is releasing their reports, they're also seeing incredibly tight supply. That it's not currently a balanced market, and there's definitely a need to increase the supply that's out there. This is a chart that I actually just started creating this year, because the question we got quite a bit going through the pandemic was what's happening with new listings, and how is that affecting the tightening of supply. And you can absolutely see the effects of the pandemic starting in March, and even going towards now, where we saw a huge dip, almost 1,000 listings. This is MLS wide, just to kind of clarify that, but almost 1,000 listings MLS wide difference in April. So not only did the demand not change significantly, but we saw a pretty significant decrease in total supply. Last month and in August definitely saw a narrowing of those numbers. So we're getting a little bit more back to normal, but we're still not listing, even though number of sales may be up a little bit, we're still not listing as many. So it's just creating more and more pressure on an already very stressed marketplace. And then I just wanted to include some additional information, as I mentioned earlier in the presentation. We do keep market stats up to date on a monthly basis on our website. You can go in and pull specific information from a specific county, a specific date, all of that, and you really customize your own reporting. Or of course, you can utilize the report that is compiled monthly, and you're welcome to pull that information and add it to your own letterheads and share it with your clients, consumers, and family if you are interested in sharing market data. We also use that information and release it by region or by region that we put together on the RASCW Facebook page, which are also it's kind of a nice snapshot, something that you can share as well. So we really do want to set ourselves as the place to get market information. And so if you ever have any questions, you're of course welcome to contact a member of our staff, myself included. And that's really it for the market stat update. I guess I will check now and see if we do have any questions on that have come up. Bill Baker wants you back more, Mark.
Thanks, Bill. And by the way, if you want more of me in that way, I have provided the slideshow to Ruth. I don't know how you might be able to get it out. I know we went through some of that pretty quickly. You might want a little more time to digest it. So know that it's available.
So we will be sending out an email tomorrow, and the email will have a link to a review page as well as access to the slideshow presentation so that you can use it. This recording will also be available on our Facebook page and our YouTube page probably by the end of this week. So you will have the ability to access it whenever you want. It did go fast, so I'm sure that there'll be plenty of opportunity for folks to go back and take some more specific notes. We did have somebody asking about the grocery store slide specifically. They apparently wanted that piece of information to share. I guess we can go back. I don't see any new questions, but maybe we can go back to a question that was posted about the movement of rural elderly population. She says that anecdotally, I found that many older rural residents don't want to move into metro areas, but they're lacking the services and specifically like medical and groceries, etc. Have you seen any trends, or do you have any information or insights into that?
I think it goes to some of the national data that I've presented regarding the lack of migration with only a 5% movement rate. And I would tend to agree with with the questioner's comment that being closer to areas with greater amenities are far better. And I think if you were to put any number of these folks into buildings that have greater density, and maybe even get them up 4 or 5 stories, which they would abhor before going in. But once they go in, they go, hey, look at what's happening down there, and look what's happening over. It ends up being actually an interesting place to be for many. That said, that first step is a really, really difficult one and involves just a whole series of challenges. But yeah, the migration rate is difficult. And actually that's a difficult thing too. Wisconsin looks more like Europe than it does the United States. And I say that we've got more of an aging population, and your comment is right on when it comes to some of the demographics. And to maintain some of these more rural markets, I want to say keeping some of those who are older homeowners there might be sensible from a housing value perspective, but certainly not from what they need, and that's far more important.
Great. So it is 5 after 10. So if there are no additional questions, I did have one question about membership. We are actually seeing strong member numbers, fewer realtor renewals, or not renewals, but new members than we expected or than we budgeted for, but that's no surprise considering testing facilities were shut down for a couple of months. But we are actually seeing quite a few new members. So that is, that'll be interesting to see going forward as we see fewer sales spread over a larger number of members. So definitely something interesting to see. Again, just this email, both presentations as well as this video will be available, probably the resources will be available tomorrow. The videos will be available by the end of the week. And we thank you so much for being here, Mark. Your information, as always, is very in-depth and really interesting. And so we really are so glad that you were able to make it here today. No thunderstorms, no lightning. We all survived. And thank you to everyone who was able to log on today and join us.
Good enough. Thank you, Ruth. Well done.
Thank you. Have a great day.
You too. Bye.